Okay, welcome everyone to our Ask the Experts webinar today on tax implications for distressed companies. We have a large crowd today and I appreciate each of you joining. My name is Ryan Gamble. I'm a Senior Managing Director with Riveron and lead our national tax practice. This is our second webinar focusing on tax issues surrounding COVID-19 and its impact on our business economy. However, Riveron has conducted several webinars related to COVID-19, covering ways to manage liquidity through the CARES Act, the impact on the financial close process, as well as financial operations and reporting, in addition to publishing a number of thought leadership articles on a variety of topics related to COVID-19. Our goal today is to highlight key tax issues we're seeing and addressing with our clients as they work to mitigate the impacts of a downturn on their business operations. I'm joined today by three of my colleagues. Gary Bedsel is a Managing Director in our Atlanta office. Gary is an expert in M&A tax and restructuring. Gary has more than 20 years of experience working with companies, both public and private, domestic and international, across a number of different industries. Ann Heffington is a Managing Director in our Dallas office. She has over 30 years of experience focusing on global tax accounting, developing tax efficient structures, leading integration of acquired companies, and implementing transfer pricing. Melissa Dennis is a manager in our Denver office. Melissa has experience in tax planning, domestic and international restructuring, IRS audit support, and ASC 740 tax accounting. Before we jump into the content today, just a few key reminders. On our website, riveron.com, you can access all of our webinars and thought leadership on business issues related to COVID. During the webinar, we will ask 4 polling questions that must be answered to obtain CPE. Please make sure your pop-ups are enabled, as sometimes they can prevent the polling questions from appearing on the screen. We welcome your questions. There is a Q&A option in Zoom. We will try to address those questions during the course of the presentation. However, if we're unable to address some of or all of those questions, we'll provide a list of the questions and our responses to everyone participating on this webinar. The webinar evaluation form and CPE certificate will be emailed to you within a couple of weeks, along with today's presentation. And with that, I will turn it over to Ann Heffington to provide an update on what's transpiring around the Payroll Protection Program. Ann?
Thanks, Ryan. Good morning or afternoon, everyone. Let's start with background on the Payroll Protection Program, commonly referred to as the PPP. On March 27th, the CARES Act was signed and it authorized $349 billion for the Small Business Administration to guarantee loans to eligible businesses impacted by COVID-19 to cover certain expenses. By April 16th, this initial $349 billion was gone and an additional $310 billion was added to the fund. The PPP was designed to assist small businesses with cash flow to enable them to continue to pay employees and keep them on the payroll. To qualify for loan forgiveness, 75% of this loan was to be spent on payroll within 8 weeks of receiving the funds from the lender. So that's an important point to remember. The funds were supposed to be spent within 8 weeks of being received from the lender. We'll circle back on that later. When the CARES Act was signed in late March, the economy was expected to be fully operating by mid-May. And here we are. Some states are opening up quite a bit, like Texas, where I am, but there are others that still have significant operating restrictions. So this 8-week payout period has created a hard decision for the small business owners. They can either pay their employees while they're not up and fully operating or forgo loan forgiveness. Let's talk about forgiveness. The loans can be forgiven to the extent they're used to cover eligible expenses. These eligible expenses include payroll, interest, rent, and utilities. Payroll covers salaries, wages, commissions, and tips limited to $100,000 per employee on an annual basis. Employee benefits, state and local taxes assessed on employee compensation, but it does not include employer share of FICA. The other eligible expenses include interest on covered mortgage obligations for real and personal property used in the company's business, rent for any covered obligation, and utilities including electricity, gas, water, telephone, transportation, and interest. For the rent and for the interest, those covered obligations needed to be in existence as of February 15th of this year. The non-payroll cost, interest, rent, and utilities are limited at this point to 25% of the forgiven amount. So when you're preparing your request for forgiveness, keep in mind you should limit the amount you use to cover those items to 25% of your forgiveness amount. Income from forgiveness is excluded from gross income. The borrower must apply for forgiveness from the lender that services their PPP loan. On May 15th, so just the end of last week, the SBA released Form 3508, a loan forgiveness application. Again, that's an SBA form, not an IRS form. This loan forgiveness application will help borrowers determine their eligible payroll costs, their full-time equivalent employees or FTEs, and if any, loan forgiveness reduction, the salary, hourly wage reductions greater than 25%. In addition, the application has borrower representations and certifications, such as these documents submitted are true and correct. The funds were used to cover eligible expenses. The borrower must maintain documentation to support these eligible expenses. For payroll, copies of federal, state, and local payroll tax filings would cover the number of employees and pay rates for the covered period. Interest, rents, and utilities could be documented by canceled checks, payment receipts, or account transcripts. Once your application is submitted, the lender must decide on forgiveness of the loan within 60 days of receipt. For those of you that have already received the funds, this is a little late to tell you, but there are some funds available. So if a company gets a loan, a best practice is to use a separate bank account for the incoming funds and for payment of these eligible expenses. The Paycheck Protection Program has had a lot of guidance that has come out since it was enacted back in March. When it was signed into law with the CARES Act, initially borrowers were not required to seek credit elsewhere, and they were just to certify that the loan was necessary. Some of the SBA frequently asked questions have come out to address and it's actually created concerns in the marketplace. On April 29th, question 39 in answer said, all loans in excess of $2 million and other loans where appropriate would be reviewed by the SBA following the application or for forgiveness. This made a lot of the loan recipients uncomfortable. How could they prove that the loans were appropriate? Did that mean that they no longer were okay with not seeking credit elsewhere? On May 5th, the SBA added answer to question number 43. Borrowers who applied for the PPP prior to April 24th and fully repaid the loan prior to May 14th would be deemed to have made their certification in good faith. This repayment date was moved to May 18th. So if they received the loan, decided that the new rulings made them uncomfortable, and they wanted to return the funds, no questions asked, that return date was May 18th. On May 13th, the SBA added question and answer 46, where the SBA and Treasury Department determined that any loan in excess of $2 million would qualify for a safe harbor, meaning they have requested the loan in good faith. It's a little late for those companies that had decided they should return their funds, but that came out on May 13th. Also recently, IRS Notice 2020-32 was released, which denies the deduction for expenses that are paid and forgiven under the PPP. So let's think about that. These expenses that are being covered by the PPP are payroll, rent, interest, and utilities. Those are general business expenses that are deductible. This has caused quite an uproar by bipartisan parties, and they're in agreement this is not the intent of the PPP. On May 18th, Treasury Secretary said he was open to change in the PPP terms. And then just this morning, it was announced the House is to vote next week on a bipartisan PPP bill, which is considering extending the loan repayment, which was initially 2 years, extending the rehiring timelines, and forgiving expenses beyond that 8-week period that I mentioned earlier. So one thing is certain in the Paycheck Protection Program, and that is change. Please keep your ears open and watch for further updates on this. So let's go to our first polling question. If your company has a PPP loan, which area is most concerning? A, the timeline for payroll expenses to qualify for forgiveness. B, the potential challenge of the need for the loan. C, the record keeping required to support loan forgiveness. Or D, not applicable, did not receive a PPP loan.
Thank you, Ann. As we wait for our audience to answer those questions, what are you seeing in the marketplace around the PPP loan?
Well, as I kind of mentioned, there's a lot of frustration. There are companies that got the loan in that first tranche before it ran out. And when the SBA said that they would need to, they would be audited, they returned the funds. And then the SBA came out and said, oh, we won't look at any loans under 2 million. You're certified in good faith. So just a lot of frustration and confusion and acknowledgement that Congress rushed to get something out before it was thought through fully. So let's see what the answers are. Not applicable. All right. A lot of people did not get a loan. For those that did, it's split between the 8-week payroll period and the record keeping. Great. Now, Melissa, we'll turn it over to you. Discuss cancellation of debt income.
Thanks, Ann. That was very insightful on an evidently continually changing topic. So as we continue to think about debt forgiveness and debt modifications, cancellation of debt income is likely where your focus would be, as this is what would generate taxability. In this next section, we will talk through a high-level overview of what cancellation of debt income is, when this income is taxable, and what are triggering events. So to kick it off, we'll dive right into the definition. Cancellation of debt income, often referred to as COD income, is the measure of economic benefit received by a borrower when debt is canceled or discharged for less than the adjusted issue price. Meaning, if you have a loan and for XYZ reason, you either don't have to pay it back or you will pay back a lesser amount, the economic benefit of what you would have paid versus what you will be paying can be seen as cancellation of debt income. Generally speaking, cancellation of debt income is taxable and is included within gross income on the tax return, which is pretty adverse for the borrower as it results in what has been coined as phantom income. That is to say, you're having taxable income without a corresponding cash to pay the tax. There are a few exclusions to this rule of taxability, one of which would be if your debt is discharged as a result of a Title 11 bankruptcy case. Another would be if the discharge occurs when the taxpayer is insolvent, but the exclusion in this case would only be to the extent of insolvency. So to add to definitions here, an insolvent taxpayer is one who has liabilities in excess of fair market value of their assets. So when we say income is excluded to the extent of insolvency, that means that the cancellation of debt income is excluded to the extent that the liabilities exceed the fair market value in the taxpayer's assets. So just note here that reliance on this exemption generally requires getting an appraisal or other third-party support for your fair market value to really prove the insolvency. In addition to the above, there are a few other exclusions that we won't dive into too deep. These would relate to qualified farm indebtedness, qualified real property business indebtedness, and certain qualified principal residence indebtedness. So when cancellation of debt income is excluded from your taxable income, it's generally applied to reduce certain tax attributes and the tax basis of the reporting entity. There is a prescribed order in which these attributes should be reduced, which I have listed on the slide for reference, but first would be net operating losses, followed by general business credits, minimum tax credits, capital loss carryforwards, the tax basis of property, passive activity losses and credit carryforwards, and foreign tax credits. You can elect to change this order to first reduce the tax basis within your property instead of net operating losses. However, the tax basis in property can only be reduced to the extent that the aggregate tax basis exceeds liabilities, meaning you cannot reduce the tax basis in your assets to a point in which your liabilities would then exceed the tax basis in your assets. And keep in mind when doing this that from a tax accounting perspective, any reduction in these tax attributes would result in a write-off of the related deferred tax asset. And if you had reserved against these deferred tax assets with a valuation allowance, that would also be released or reduced as applicable. So after the taxpayer has gone through the exercise, any cancellation of debt income in excess of the reduced tax attributes may be permanently excluded from taxable income without generating a corresponding attribute reduction. This is commonly referred to as black hole income because that excess cancellation of debt income somewhat disappears for tax purposes. You do have to be careful with black hole income because that can result in triggering an excess loss account at the parent company level. And to just touch high level on what that means and why you have to be careful with it, an excess loss account refers to when the tax basis that a parent company holds within a subsidiary becomes negative. And the tax issue here is that if that subsidiary then becomes worthless, that excessive loss account that the parent held within the entity turns into taxable income for the parent. So now that we've talked through what cancellation of debt income is and when it's taxable or not, let's walk through what the IRS has listed as triggering events to cancellation of debt income. The first one we have listed here is probably the most intuitive. It's cancellation of all or a portion of outstanding debt. Significant modifications to debt instrument is the next triggering event. We'll go more in detail on what this means in the next section. Another triggering event would be the conversion to equity, which in this case, the debtor is treated as having satisfied the debt with an amount of money equal to the fair market value of the stock. Then we have a debt for debt exchange or a debt for property exchange. And in both of these instances, similar to the equity, the debtor is treated as having satisfied the debt with an amount of money equal to the fair market value of the new debt or the fair market value of the property received. So in either of those three situations, if the fair market value of the property exchanged is less than the debt, you would have cancellation of debt income. The next would be a related party acquisition, in which case the debtor is still treated as having acquired their own debt. So any differences in prices there would still lead or could still lead to cancellation of debt income. And finally, we have discharge by a shareholder contribution of debt to the capital of the borrower. So basically saying a capital contribution by a shareholder of the corporation's own debt. And in this case, the debtor is treated as having satisfied the debt with an amount of money equal to the shareholder's basis in the debt. And if the shareholder's basis in the debt is less than the adjusted issue price of the debt, the corporation could recognize cancellation of debt income. So moving on, we have our second polling question. This one says, what option is your company currently considering to cancel debt? So we have our options listed from the previous slide here. A, cancellation of all or a portion. B, significant modifications. C, related party acquisition. D, exchange of debt for equity, property, or other debt. E, discharge by shareholder contribution of debt to capital. F, other, or G, not applicable. Give you guys just a second there.
Great. Thank you, Melissa. We've had a question come through regarding CODI income. Does the creditor tell the taxpayer how much CODI income to recognize, or is that something that the taxpayer has to compute on their own?
Great question. So that depends. There are instances in which a taxpayer will receive a Form 1099-C from the creditor, which states the amount of cancellation of debt income that they need to recognize. However, it is important for the taxpayer to be able to calculate this amount on their own in order to both review the form they receive for accuracy and or just to be able to identify the amount of taxable income in instances where the form's not received. And then in addition to that, you're going to want to do your own cancellation of debt income analysis in order to determine if you qualify for any of the exclusions. All right, so looking at the answers, seems like the overall consensus is not applicable, so that's good. Next, we have significant modifications to debt instruments, very interesting. If you need any help determining if a modification is significant, hopefully we'll cover the basics in this next section, but we're more than happy to help answer any questions as needed. So as we noted on our list of triggering events, a significant modification to debt could lead to taxable cancellation of debt income. As with all things tax, the IRS has its own definition of what would be considered a significant modification. In this section, we will walk through what is considered a significant modification under the tax code and the implications thereto. So, a modification of a debt instrument may result in a deemed taxable exchange of property, which is what triggers the cancellation of debt income. Generally speaking, a modification is only considered an exchange if it's considered significant. If it's not considered significant, then it's generally not treated as taxable. So how do we determine if a modification is significant? The IRS has outlined a two-step analysis in determining significance and thus whether a deemed taxable exchange has happened. The steps will appear relatively straightforward, however, each does have its own nuances. So the first step is to determine if the debt was modified. The term modification is broadly defined in the tax regulations, but when we talk about a modification, we're generally referring to any alteration, including any deletion or addition, in whole or in part, of a legal right or obligation of the issuer or holder of a debt instrument. A modification can occur from amending the terms or for exchanging debt instruments. Some common examples of debt modifications would include changes to the interest rate, maturity date, or changes to the property securing the debt. Please keep in mind this list is not all-inclusive and that each modification would require its own analysis. So once you've then determined whether or not a modification has occurred, the second step would be to determine if the modification is significant. So as I said, the steps seem pretty straightforward. You have 1, determine if the debt instrument was modified, and then 2, determine if it's significant. But again, each kind of has its own unique characteristics. So something to keep in mind when going through this analysis is determining whether a significant modification has occurred is very much facts and circumstance. So the determination of significance is driven by whether the rights or obligations of the parties to the debt have altered in an economically significant manner. So as we saw with cancellation of debt income, where they were focusing on the economic benefit, here again, the tax code is looking to see, is someone benefiting in a manner that is economically significant? So modifications for this second test should be analyzed both individually and in the aggregate, because a number of small modifications that could be insignificant on their own could still constitute a significant change when they're considered together. So while all this might seem rather vague, the IRS has set forth 6 tests to help analyze whether a modification would be considered significant. These are the change in yield test, which under this test, if the yield on a new debt instrument varies from the annual yield on the old debt instrument by 25 basis points or 5% of the annual yield, then the change is seen as significant. A change in timing of payments test, which looks to see if there's been a material deferral of scheduled payments, which would then be significant. Change in obligor or security, which says that the substitution of a new obligor on recourse debt is generally significant. However, the change on a non-recourse instrument is generally not significant. Changes in the nature of the debt instrument. So generally here, a change from recourse to non-recourse or vice versa is going to be seen as a significant modification. The next test is changes to accounting for financial covenants. Generally, a modification that adds, deletes, or alters customary accounting or financial covenants is not significant. However, in these instances, there are times where the issuer is going to make a payment to the lender in consideration for agreeing to the modification, and that payment then gets taken into account under the changes in yield test. So this could still result in a significant modification. And lastly, the general test, which is kind of the catch-all facts and circumstances test that goes through and analyzes each change, both individually and in the aggregate, to determine if a significant modification has occurred. If another test does apply, then you wouldn't do this general test, but if you go through, this would be the last test you would do to just make sure. After completing this analysis, if it's determined that the debt modification is in fact significant and is deemed a taxable exchange, both parties to the debt should analyze the related income tax consequences. So we're not going to cover the creditor implications, but if you do have any questions on this, please feel free to reach out and we'll get back to you with a response. We're just going to focus on the debtor side. So for the debtor, the income tax consequences are determined by comparing the new debt issue price to the old price. The old price is generally the outstanding principal amount, while the new issue price will depend on a few facts. For the new issue price, you first have to determine if your debt is publicly traded. And when thinking through that, it's important to keep in mind that publicly traded debt does not necessarily mean that the debt is held on a public exchange. I've listed on the slide the Treasury regulation that covers what the IRS defines as publicly traded, but key considerations relate to the availability of the price or a quote related to the debt to brokers or persons who regularly purchase or sell debt. So once you determine whether or not your debt is publicly traded, if it is publicly traded, the new issue price would be the fair market value. And if it's not publicly traded, you then need to confirm if there's adequate stated interest or not. If there is adequate stated interest, then the new issue price is the stated principal amount. If there's not, then the new issue price would be the imputed principal amount. So now that we've covered cancellation of debt income and significant modifications that could lead to cancellation of debt income, we're going to switch gears a bit into a different section of the tax code called Section 382. And I will let Gary walk you guys through this and why it is important.
Thanks, Melissa. So 382, what are we talking about? Companies in distress often have, for income tax purposes, what's referred to as net operating losses, or NOLs. An NOL is essentially a tax loss for a particular year. Historically, before 2018, tax losses could be carried back 2 years to offset taxable income in those previous years and carried forward for up to 20 years before expiring. For example, if a corporation had taxable income in year 1 and paid taxes on that income, and then it had an NOL or a loss, tax loss in year 2, the corporation can carry the NOL back from year 2 to year 1 and obtain a refund of the taxes paid in year 1 by filing an amended return for year 1. Any remaining NOL could be carried forward up to 20 years, at which time the NOL would expire for income tax purposes. The Tax Cuts Jobs Act changed these NOL carryback and carry forward periods for NOLs arising in 2018 and later. The carryback opportunity was repealed, and NOLs could be carried forward indefinitely, but there was then imposed up to a 20% haircut on the amount of NOLs that could be used. In other words, the NOLs could offset up to 80% of the taxable income. With the CARES Act passage, a third bucket of NOLs depicted in the middle row on this chart was created. For NOLs arising in 18 through 2020, these NOLs could be carried back up to 5 years and carried forward indefinitely, and were not subject to the 20% haircut for 2018 through 2020. Because of the 5-year carryback period, this provided many corporations immediate access to liquidity. The IRS has promulgated rules allowing corporations to obtain expedited refunds for these carryback of NOLs. So turning to 382. 382 was designed and enacted to prevent profitable corporations from trafficking in corporations with NOLs. For example, absent 382, shell companies that have ceased doing business but have remaining NOL carryforwards would be left in existence by their owners and could be sold to profitable companies just for the ability to use the NOL carryforwards. 382 and its counterpart, Section 383, apply to certain tax attribute carryforwards other than NOLs. These include foreign tax credits, minimum tax credits, general business credits, and capital loss carryforwards. If 382 applies, NOLs can only offset a limited amount of taxable income. Melissa will explain how that limitation is calculated shortly. This is a distinct limitation that's unrelated to the 80% limitation mentioned earlier for the bucket of NOLs arising after 2018. So when does 382 apply? It applies when immediately after an ownership shift involving a 5% shareholder or any equity shift, the percentage of the stock of the lost corporation owned by one or more 5% shareholders has increased by more than 50 percentage points over the lowest percentage ownership of such shareholders at any time during a testing period that's generally 3 years. Let's break that apart. That's a lot to deal with in that one long definition of ownership change. So first thing, we need to determine who are the 5% shareholders at the testing date. And ownership is determined at the ultimate individual level. If there are chains of ownership through various legal entities, you generally go all the way to the top till you reach a real living person. That means valuations are going to be needed once you reach the top if there are separate classes of stock outstanding. Okay, shareholders can be grouped or aggregated or segregated for purposes of determining whether there are 5% shareholders. We'll get into more details on that in the next slide. Owners, people also working together to acquire stock are generally grouped. Regarding valuations, there are several times that you may need valuations. As Melissa mentioned earlier, you may need a valuation for determining your fair market value of assets for purposes of the insolvency exception for COD income. You also may need to determine the fair market value of stock if you have a debt for equity exchange, or the fair market value of debt if you have a debt modification or a debt exchange for purposes of determining the issue price. Also, you may need to determine the fair market value of debt to see if a significant modification has occurred. For 382 purposes, values relevant for determining whether an ownership change has occurred for purposes of valuing classes of stock, as well as determining the limitation amount. You also may need evaluation for fresh start accounting following bankruptcy, and we'll get to bankruptcy in just a minute. So in addition to aggregating groups of shareholders, there are rules on segregating groups of shareholders for purposes of determining who the 5% shareholder is. Shareholders who acquire their stock in certain transactions are often segregated into separate groups. You can see the listing there of certain types of transactions that can require segregation. So in summary, you must have an ownership change to have a 382 limitation. To determine whether you've got an ownership change, you first determine stock ownership, assign value to the stock, calculate the total value and determine who's the 5% owner, and then compare that ownership to the lowest percentage ownership of that same 5% shareholder over the last 3 years. If the sum of the increases is more than 50%, an ownership change has occurred. Okay, with that, I think we move to a polling question. Yes. So a 382 ownership change is calculated based on the value of the stock held by the shareholder on the testing date. True or false?
Hey, Gary, thank you for that. Notice in the CARES Act that in certain circumstances, the government can receive an equity interest in exchange for loans or benefits. In those instances in which the government receives equity, does that impact the 382 ownership change analysis?
So the IRS has come out and stated that the intention of the act is not to create an ownership change. This is similar to the TARP provisions back in the mortgage crisis. The intention is not to have an ownership change there as well as here, so expect guidance from the IRS on this shortly. Okay, and there are the results of the poll. True, and the answer is true. It's based upon value. Okay, with that, Melissa is now going to tell us once an ownership change has occurred, what's the 382 limitation amount?
Thanks, Gary. So as you said, once you've determined that an ownership change under Section 382 has occurred, the next step would be to calculate the limitation. The broad formula for the annual limitation is the value of the old loss corporation multiplied by the long-term tax-exempt rate. The federal long-term tax-exempt rate is published monthly in the Internal Revenue Bulletin, while the value of the loss corporation is generally equal to the fair market value of the stock immediately before the ownership change, subject to a few adjustments that are outside the scope of this presentation. It's important to keep in mind that, as Gary mentioned previously, the purpose of 382 is to avoid the trafficking of tax attributes. In line with this thinking, there is a continuity of business enterprise requirement, which will drop the limitation to 0 if the business enterprise of the old loss corporation does not continue at all times during the 2-year period following the change date. And so when I say drops the limitation to 0, that's bad because your limitation is the amount of old loss corporation losses that you can use. So if the business does not continue at all times for 2 years, then you don't get to use any of those pre-existing losses. So once you've calculated the base 382 limitation, there are additional adjustments to consider, which, subject to certain limitations, can increase or decrease your annual limitation. These adjustments are analyzed through a 5-year recognition period, which starts with the date of the ownership change. So the base limitation, again, meaning the annual allowable amount, can be increased by recognized built-in gains, while the amount of losses limited can be increased by recognized built-in losses. The nature of the adjustments will depend on whether there was a net unrealized built-in gain or a net unrealized built-in loss at the ownership change date, and the adjustments to the limitation cannot exceed the amount of net unrealized built-in gains or net unrealized built-in losses that you had at the ownership change date. So when we kind of think through these, again, the idea of Section 382 is that you want as big of a limitation as you can get or as little of pre-change losses subject to limitation as possible. So a common strategy we see is that if a company has built-in loss at the ownership change date, they're going to try to hold on to that loss for the 5-year recognition period in order to avoid increasing the net operating losses subject to limitation. So in order to calculate the amount of losses or our limitation adjustments, we need to calculate the amount of built-in gains and losses that we had at the change date. An in-depth discussion on this is outside of the scope of this presentation because there are a lot of little nuances to it. However, currently, notice 2003-65 is the guidance relied upon in performing these calculations. Under the notice, there are 2 safe harbor methods that you can use to calculate your built-in items: the Section 1374 approach and the Section 338 approach. Under the Section 1374 approach, a loss corporation identifies and measures its net unrealized and recognized gains or losses based on the principles for calculating net recognized built-in gain for the conversion of a C corporation to an S corporation under Section 1374, which is why it's coined the Section 1374 approach. In general, this approach relies on the accrual method of accounting and only permits a taxpayer to increase its Section 382 limitation by a recognized built-in gain arising from an asset with a built-in gain on the date of ownership change, where the loss corporation actually disposes of such asset during the recognition period. So that's important to keep in mind. You actually have to dispose of the asset under this method. Under the Section 338 approach, a loss corporation identifies and measures its net unrealized and recognized gains or losses by comparing the company's actual items of income, gain, loss, and deduction against those items that would have arisen had the loss corporation sold its assets to a third party that assumed all of their liabilities on the change date. So had a hypothetical transaction occurred on the change date. Under this approach, the loss corporation generally is able to increase its limitation by hypothetical depreciation and amortization deductions resulting from the step up in tax bases from that hypothetical sale that we say happened at the ownership change date. And these deductions generally exceed the actual depreciation and amortization deductions allowable to that loss corporation with respects to its assets. And note that if this method, that's allowable regardless of whether the loss corporation actually sells its assets or not during the recognition period. So as with all things tax, there's a lot of change. So in September 2019, the Treasury and IRS proposed a new framework for taxpayers to calculate their built-in items. The new framework's effectively going to eliminate the use of the 338 approach, and it removes a lot of the favorable provisions under the 1374 approach. These proposed regulations are actually going to make Notice 2003-65 irrelevant. And while, it kind of seems like these new regulations have a lot of taxpayer unfavorable provisions to them, it should be kept in mind that these actually answer a lot of the questions that were left open by the Tax Cuts and Jobs Act. So in some senses, it is very helpful. The new regulations are going to apply to any ownership change that occurs 30 days after the regulations are adopted as final, which is coined the delayed applicability date, subject to a few exceptions. And so in the meantime, taxpayers can continue to rely on Notice 2003-65 until the delayed applicability date, unless you qualify for transition relief, in which case you can rely on the notice indefinitely. If you have any questions on what ownership changes qualify for transition relief, feel free to reach out and we'd be more than happy to help figure that out for you. And with that said, we've covered Section 382. And so now I'm going to flip it back over to Gary to discuss bankruptcy and the tax considerations thereof.
Thank you, Melissa. So back when I was in law school, the law library had a bunch of things they have less of now, and one of that was books. We have much less books in law libraries today. And I remember one entire shelf was devoted entirely to the U.S. Code, which is the codification of federal law in the U.S. And one very small volume of that was bankruptcy. That's Title 11. And the income tax laws are in Title 26. So the point being, they're both federal laws. What controls while the debtor is in bankruptcy? And Title 11 generally defers to the Internal Revenue Code for any tax issues, even if the debtor is in bankruptcy. So the purpose of bankruptcy, specifically a debtor in Chapter 11, is to give the debtor a fresh start. There's such a thing called Chapter 7, which is generally a liquidation, but we're not going to cover that today. So this give the debtor a fresh start often conflicts with the goal of the IRS, and that is to collect taxes that are due and owing. With that in mind, let's cover the bankruptcy process in general for a moment. So bankruptcy begins with the filing of a petition. The petition causes a stay to automatically go into effect. What does that mean? So the stay prevents for a period of time any collection activities, judgments, foreclosures, etc., that creditors could otherwise pursue against the debtor. The debtor is prevented from paying any pre-petition debts without getting approval of the court. That's going to be important from a tax standpoint for a couple of reasons we'll discuss in a minute. So after the petition's filed, the debtor must file and get court approval for a written disclosure statement before there can be any vote on a plan of reorganization. How does the debtor get its fresh start and get out of bankruptcy? The disclosure statement must provide adequate information concerning the affairs of the debtor to enable any holder of a claim to make an informed judgment about the plan. So the court will begin setting bar dates after the petition is filed. What's a bar date? It's a date by which creditors must submit a proof of claim to have a right to participate in the bankruptcy process generally. The creditor, in order to submit a proof of claim, must provide its name, address, the amount of debt, and provide proof that the debt is real. Generally, that might be evidence of loan documentations, etc. Bar dates for tax debts are no sooner than 180 days after the petition is filed. So after the disclosure statements have been filed, the debtor begins negotiating the plan. The plan will generally classify claim holders as secured creditors, unsecured creditors, general unsecured creditors, and equity holders. An entire class of claims is deemed to accept a plan if the plan is accepted by creditors that hold at least 2/3 in amount and more than 1/3 in number of the allowed claims in the class. Following approval of the plan, the debtor emerges from bankruptcy. So what changes for the tax function while in bankruptcy for the corporation? Well, first, as I mentioned earlier, the debtor corporation can't pay pre-petition taxes without court approval. And it's not always intuitive what's pre-petition and what's post-petition, especially since the tax year generally doesn't end as a result of filing the petition. Things that don't change, the debtor still needs to file tax forms, including income tax returns for the year, and pay current taxes. Regarding pre-petition taxes, there's one thing to point out. Debtors may need to pay pre-petition taxes referred to often as trust fund taxes. Those are taxes like employment taxes, sales use taxes, where if the debtor doesn't pay those taxes, the taxing authority could come after the officers or directors of the company for them. So debtors want to include those taxes in things called first day orders. This is motions filed to the court where the court permits the debtor to do certain actions that otherwise are not permitted. So it might be worth considering for debtors who owe employment taxes and sales and use taxes to include these in first day orders so the debtor can pay them, otherwise the officers may be liable for those taxes. What's another type of first day order that debtors may want to file a motion for? So debtors may also want to seek a motion to restrict equity trading. We talked about 382 and ownership changes. The debtor may want to prevent an ownership change from occurring, so they seek a first day order to prevent sales of stock. An additional thing that debtors may seek to prevent is debt trading that could prevent the debtor from qualifying under Section 382 L5, often referred to as the L5 provision. So what's L5? So if you qualify under L5 and there's an ownership change pursuant to the bankruptcy reorg, generally you're not going to be subject to an ownership change limitation. And how do you qualify? The debtor must generally transfer at least 50% of its stock to its former shareholders or qualified creditors in exchange for cancellation of the shareholders' interest or the creditor's claims against the debtor. Qualified creditors include only old and cold creditors, and those are defined as creditors in the ordinary course of business that have owned or have owned debt for a continuous 18 months. So the point being there, if you want to qualify for L5, you restrict debt trading so you can maintain a sufficient number of old and cold creditors to qualify. The downside of qualifying for L5, I mentioned earlier, there is no ownership change limitation, but there is a downside. You have to haircut your NOLs by the amount of interest paid or accrued during the pre-reorg period of the current year and the preceding tax years and all the debt converted to stock of the company. So that could be a significant hit. There is a way out, though, if you determine that that's going to significantly reduce your amount of your NOLs, and it's called the L6 limitation or the L6 rule. And if you elect out of L5 and into L6, generally if there is an ownership change, the debtor corporation can include the increase in value as a result of the discharge for purposes of calculating the 382 ownership change limitation amount. So companies in bankruptcy need to calculate or determine, is it better to be in L5 or is it better to be in L6? L5, the interest haircut, or L6 with a 382 limitation, but you take into account the discharge so it increases the value of the company and it results in a higher 382 limitation. So I mentioned bar dates earlier. It's important to think about here that taxes, the court will set a bar date for no sooner than 180 days for the filing of the petition for any proof of claim on taxes. So following that, 363 sales, that's something that's important to point out. So the bankruptcy code permits debtors to sell some or all of its assets through a court supervised auction. For income tax purposes, this sale could be a taxable sale, meaning gain or loss recognized on the sale, or it could be a tax-free reorganization, most likely qualifying as what's referred to as a G reorg. 368 A1G is the code section. And the G reorg provides that if there is an asset sale, there's no gain or loss recognized by the corporation on that sale, but the tax attributes such as NOLs will follow over to the buyer. Substantially all the assets of the debtor must be transferred to a single acquiring corporation in order for the transaction to qualify as a G reorg. So that's kind of a summary of potential issues in bankruptcy that taxes could arise. Let's cover some financial reporting items real quick. We're running up on time here. So as you're approaching the petition filing date, things to think about for financial reporting purposes include management's assertions around indefinite reinvestment of foreign subs, long-term investment nature of intercompany loans, recovery of investments in domestic subs, and realization of deferred tax assets. On emergence, the reporting entity should project taxable income between emergence and the end of the tax year and record deferred taxes based upon the attributes and the tax basis expected to be in existence at the end of the year. For valuation allowances, consider the extent to which the weight of the available evidence provides assurance that the reorg enterprise will have future taxable income from other sources than reversals of temporary differences. And with that, I think we've reached our final polling question. When a company files for bankruptcy, which of the following is impacted from the tax function standpoint? Tax compliance, the tax year in, the tax filing status, or none of the above?
Thank you, Gary. While we're waiting on those answers, and we had a question come through on PPP, hoping you could answer. Is the COD income taxable to nonprofits?
Okay, I would say the same rules apply to nonprofits as profits. So it would be the same as I laid out in the slides on 75% is payroll. At this point, paid within 8 weeks, but of course that's up for debate and a vote next week. So you can also refer to those frequently asked questions on the SBA website, and it will give you a lot of information.
Great, thank you.
Okay, and the answer is none of the above. Compliance still has to occur. The tax year generally doesn't end. The filing status of the corporation doesn't change. Corporation still has to file tax returns and pay post-petition taxes generally. Okay, I think with that, we've reached a conclusion, Ryan.
Yeah, thank you, Gary. Thank you, everyone, Melissa and Ann. In closing, I just wanted to highlight a few additional resources that are available to you on our website, again, riveron.com, and through the links provided on the presentation. There you can find a number of additional resources related to COVID-19. We really appreciate everybody's participation and joining us today. Our next webinar is June 4th, addressing internal control deficiencies in the COVID-19 crisis, and look forward to connecting with you then. In the meantime, be safe and enjoy the rest of your day. Thank you.